This line chart shows the S&P 500 index reaching a record high of 7,621 in the summer of 2026. But that headline number hides a deeper reality. The median individual stock in the index is actually sitting 13% below its peak. This is a structural divergence. A handful of heavyweights are pulling the index higher, creating a mask that covers broad market weakness. For an investor, the danger is clear. Buying into the index today often means paying peak prices for a market that is hollow underneath. The path to protecting wealth involves identifying market leaders at the exact moment the broader market misinterprets their long-term growth strategy. While their share prices have dropped, Amazon and Disney are currently utilizing massive capital investments to reshape their business models. This chart contrasts Amazon's capital spending against its free cash flow. After management announced a $200 billion spending plan, the stock plunged 21% as Wall Street reacted to the short-term cash drain. But that spending fuels a specific result. AWS is growing at 24%. Now Disney is facing a similar overreaction. Its 25% stock drawdown is largely a response to the cash requirements of a $60 billion global expansion in its parks and cruise divisions. While the market focused on that price tag, Disney's streaming segment quietly achieved double-digit profit margins. In both cases, investors are pricing front-loaded infrastructure costs as a permanent business failure, rather than a foundation for future revenue. In the digital sector, software leaders are facing a similar penalty as they navigate the transition to artificial intelligence. Salesforce shares have fallen 41% from their peak. The primary fear is that autonomous AI will eliminate the need for the human seat-based licenses that have driven the company for decades. In reality, Salesforce has successfully monetized its transition. The new Agentforce platform has already crossed $1 billion in annual recurring revenue. Adobe has seen an even more severe decline, with a 46% plunge. Much of that sell-off was triggered by the uncertainty surrounding corporate restructuring and a series of leadership changes. However, the underlying financials remain robust, with Adobe maintaining 90% gross margins while trading at its lowest valuation multiples in years. Broadcom fell 13% during a broader rotation away from the semiconductor sector. This ignores a $30 billion backlog in new bookings for custom AI silicon. The market is pricing these companies as if they are about to be disrupted, even as they secure a monopoly over the infrastructure that AI requires. These price drops are the result of a system built on quarterly capitalism. Algorithmic trading systems are programmed to exit positions instantly when short-term free cash flow misses a quarterly target. This creates an incentive structure that penalizes management for prioritizing long-term growth over immediate margins. These algorithms respond to optical shifts in financial statements, often ignoring the long-term business value being built behind the numbers. Holding through a deep correction tests individual conviction, but it is often the necessary price for accessing suppressed valuations. Exploiting these moments requires a systematic approach, using dollar-cost averaging to buy into compressed multiples over several months. By integrating these positions, an investor can build a barbell portfolio that balances defensive consumer growth with high-margin technology. Navigating a momentum-driven market requires prioritizing a business's long-term cash flow over the short-term optical stability of a daily share price.